Once again, we are back on Soch ttalk, train of thought, with a series of episodes with Dr. Aditya Sontakke, who is the author and the expert in finance and compiled around about 6 books in finance, having a 14 years of an experience into teaching. And if we'll see his consistency as far as the academic excellence which is concerned, he did his MCom at the age of 23, MBA at the age of 25, MPhil at the age of 26, and at the age of 26 he had completed CA, went ahead with PhD at 31 years of an age, and now at 36 he had completed his CMA. Dr. Aditya, congratulations.
Thank you,
a great achievement, a great lesson for our ttalk audience. Now in this episode we'll be talking more in terms of Forex. For ttalk audience, can you just throw some light in terms of basics of Forex?
Yeah, Forex basically nowadays we all know that the companies are going overseas. They are multinational companies, so they are exposed to foreign currency transactions. So there is a risk because of foreign currency is involved. And when it is a foreign currency, there is appreciation or a depreciation. The risk of appreciation and depreciation both ways. So how to tackle with that risk? How to hedge that risk, or how to reduce that risk? For that we have various tools available in the Forex. The best available tool in the Forex is a forward contract, wherein we will have to go to bank and ask, let's say for example, if I want to pay $1 lakh, $1 lakh US dollar to some person of a US after 1 month, and if I feel that a dollar will appreciate, that means rupee will depreciate. So today, let's say if the rate is 80 rupees per dollar, I feel after 1 month it will go up to 85 rupees per dollar. So there is I will have to pay more Indian rupees to buy $1. Today I can buy $1 US at 80 rupees.
Correct.
But after 1 month I will have to pay 85 rupees to buy $1.
Correct.
So my Indian rupee outflow is more after 1 month. So this is the risk basically.
Okay.
I will have to pay more Indian rupees. So to reduce this risk, to reduce more Indian rupee outflow, I will go to bank and ask for the forward contract.
Okay.
Wherein I will ask bank to provide me $1 lakh US after 1 month. So they will give me a forward rate.
Forward rate, yes.
So if let's say that today they are telling me कि after 1 month we will sell you a dollar at 81 rupees. So now I am sure, irrespective of the market price of a dollar, I will be getting US dollar at 81 rupees.
Correct.
So now the risk of volatility of US dollar is completely gone out of my transaction.
Correct.
So majority of the importers or the exporters resort to the forward contract.
Okay, good.
Rather you can say 95% people resort to the forward contract to reduce their risk.
Good. A great simplified concept for our ttalk audience. Now can you throw some light in terms of an interest rate arbitrage?
Yes, interest rate arbitrage is basically there is one theory called interest rate parity theorem, wherein it says that the exchange rate between two countries should be same. Same means based on their interest rate of the respective countries. Like in India, if the interest rate is 5%, in US the interest rate is 2%. Then that exchange rate should reflect these interest rate differentials also.
Okay.
Yes, but if the interest rate or if the exchange rate is not according to the interest rate in India and in US, then there is an arbitrage opportunity.
Okay.
Wherein I can make a riskless profit, considering the interest rate differentials and exchange rate.
Good. Okay.
So that is the interest.
Great. Again, more clear concept on this. Can you throw some light in terms of a cover deals?
Yeah, cover deal is basically from the angle of a bank, wherein let's say if I go to bank and ask for, let's say, Australian dollar, bank will, let's say a bank is selling me Australian dollar, but suppose bank do not have a Australian dollar, so they will have to buy these dollars from some other authorized dealer. Yeah. So if bank is selling me a dollar at 60 rupees, then through cover deal bank will buy Australian dollars from some other authorized dealer at lower price, lower than 60 rupees.
Okay.
So through this cover deal, bank will ultimately end up getting some profit out of this whole transaction.
Okay, good, great. Again, a more simplified concept for our ttalk audience. Can you throw some light in terms of an cancellation and extension of an forward?
Yeah, basically those who are going for a forward contract, maybe due to some reasons, they may have to cancel that forward contract, or they may have to extend that forward contract. Like let's say I came with a contract, I go to bank for a forward contract of 3 months. But let's say if I want to extend that contract from 3 months to 4 months, then what all procedures that I will have to follow?
Okay.
What will be my loss, if at all it is a loss? Then instead of extending, let's say I want to completely cancel that forward contract, then what all steps I will have to take?
Okay.
That is all about the extension and cancellation of the forward contract.
Good, good. I think again more simplified from now. In fact, for benefit of our ttalk audience, can you throw some light in terms of an exchange rate determination?
Exchange rate. How a lot of people want to know how the exchange rate is determined. Let's say if it is a US dollar and Indian rupee. So how the exchange rate is determined between Indian rupee and US dollar? Basically, exchange rate is determined based on the demand and supply, ideally. But there are various theories which tells you how the exchange rate is determined. Like there are predominantly two theories. One is interest rate parity theory, and then another is a purchasing power parity theory. Interest rate parity theory tells you what should be the exchange rate based on the interest rate of two different countries. Okay. And another theory is a purchasing power parity theory that is based on inflation. That tells you what should be the exchange rate between two countries based on the inflation rate in those two countries.
Good.
On that basis, we can find out the exchange rate.
Great. I think Dr. Aditya Sontakke, no doubt, like in a more simplified way, the concept of an Forex which you have explained, and I'm sure like in your book which you have compiled, like simplest approach to Forex, I think it can unfold many simplified concepts for our ttalk audience. In fact, for the benefit of our ttalk audience, I would like to say this book, Simplest Approach to Forex, is available on Amazon. You can go and buy the book over there, and I'm sure like it's also, the link will be given on our as far as our website also, which is concerned. On the video also, one can go and have a glimpses of the book and can buy that book. Thanks a lot for bringing this simplified concept for ttalk audience. Thank you very much. And if the target audience, they like this episode, go to www.ttalk.net, subscribe and like the channel as much as you can, and also catch up with Dr. Aditya Sontakke in our next episode of ttalk ek Boond Soch ki. So thanks a lot for being part of this. Thank you very much. Thanks.